backed and powered by 150 years of business experience. Venue is a virtual data room trusted by the best of the Fortune 500 to move deals seamlessly from one to the other to the next too.
The food and beverage giants are under pressure from changing consumer tastes towards cleaner ingredient decks and away from artificial ingredients. This has led to a flurry of acquisitions of targets in the natural and organic space and has also made the food conglomerates vulnerable to activists and other potential acquirers. Already, H.J. Heinz and Kraft have both been gobbled up by private equity firm 3G and Berkshire Hathaway. Will these trends continue or has the sector peaked? Welcome to today's installment of Merger Talk. My name is Mark Aiello, Vice President General Manager for Venue, the virtual data room of R.R. Donnelley. Today I'm joined by David Key, a managing partner at Key & Company. David, thanks so much for joining.
I appreciate it.
Thanks. So the first question I have for you is, where are you seeing sector multiples and where do you think they'll be headed in the short term?
Probably like many sectors, they're all over the place depending on the quality of, management, IT, intellectual property, the usual things. In actual multiples, I've seen everything from 6 to 15 or more. If there are, heavy land-based agribusiness companies, they may even trade on a sort of a cap table, like in real estate. When you have a REIT, they'll trade on a cap rate, and some of those are single digits now because interest rates are low. So it is all over the board, but if you can buy something, for something like 8 times EBITDA, to go to the vernacular, I guess, it would be a good deal.
6 to 15 is a pretty wide range.
That's a very wide, very wide.
And how are valuations today affecting deal activity?
Very much. Valuations are very much dependent on that future prospects of growth, and of course in agriculture, food, and consumer products, with a worldwide community that's burgeoning and growing every day. The demand outlook is extremely strong, and if you can be positioned for that type of growth, it's very important.
And David, as you're seeing demand change and grow, are you seeing deal structures change in any way to meet that demand?
I'm not seeing terribly a big change in deal structures. Cash is always important. Tax-efficient transactions are most important. Their Wall Street has always been very creative in terms of what they can do to make a deal happen, and we'll continue to see that. One of the examples might be with such a hard asset-based asset class that we have in kind of agriculture and food. There's a lot of interest in doing work with, say, a REIT or a publicly traded company that can exchange stock for cash and assets, stock for assets, and have a tax-deferred transaction. So all the different types of tax-advantaged transactions become very important in our world.
Right. With all that creativity that Wall Street has, are there fundamental differences in how financial players approach the market versus strategic players today?
That's a really good question. I have been in the business, probably you can tell, for a little while. And it used to be that there was a very large difference between private equity firms on the one hand and strategic acquirers on the other. And inevitably, strategic acquirers would win because they could cut costs better, they could introduce better management, they could do all the things that are important in developing a new business strategy for product lines and consumer brands and everything. Today, I've found that with the involvement of private equity firms in the sector more and more, both agriculture and food, they actually play more like a strategic player, and so they can see those changes in the income statement, and they can cut costs, and they can look at revenue enhancements and market development in a different way. That they've had a evolution among themselves. So they actually play more like strategic players now.
Interesting. And then when you look at successful strategies, successful integrations, how do the successful companies drive a deal that is truly accretive to value? How do they approach diligence, and how do they manage the integration?
Well, you have to know you have to go deep. I think the usual phrase on Wall Street is deep dive. And if you have the right resource and talent, typically management, typically advisors, typically experts that have seen this before again, they can help you with that. And cutting costs is important, probably the most important, as usual. But there's a lot of other ways to drive value to the bottom line, and these guys are smart. Wall Street smartened up, and the strategics have actually taken a page from Wall Street. In many ways, they've smartened up in terms of transaction structuring, financing, and their ability to drive more income to the bottom line. So it's an evolving, the asset class itself, as I said before, is evolving into a much more institutional asset class, and there's much more interest from institutions now than there was ever before.
Great. David, thank you so much for joining. For more merger talk, visit thedeal.com.